Yeah, probably could, but no worries. Now it won't end. Don't worry. Okay. Um, where was I? Sorry about this. Whatever this is. Okay, delete you. Where are you? Yeah. So I was talking about capitulation and stuff. Yeah. So did you guys get it? Do you have any questions? What did I? Okay. One sec. Sorry. Can you see the screen, right?
Yes.
Okay. Yeah. Let's get back to stocks. Yeah. Yeah. So technical and fundamental analysis. You guys already probably know the who doesn't know what this is. Like, what's the difference? You guys know or don't know? Do I need to explain it?
Yeah. Basic level like fundamental and technical analysis. Fundamental, I think so, is based on news and stuff like that. And on technical analysis, you can go like what are the support levels, like where last time the currency or coin make a dip and make a support and come at top level.
Yeah. Yes. Yes. Yeah. So okay, I'll give a brief overview. So fundamental analysis is basically uh, if you think in terms of coins and cryptos and all those things, they are mostly related to like macroeconomic situations and news and stuff like that. If you think in terms of stocks, it deals with macroeconomic situations, but it also deals with microeconomics, which is specific company metrics. So how like the financial statements of the company, which I can show you actually. It's not that complicated that how people make it. It's not that complicated at all actually. You need to know a little bit of business terminologies and stuff, but it's quite simple. I don't think anybody would have a problem. So if you go to financials here, this pretty much is literally fundamental analysis. This is what it is. You go and just you see all these things. What mm, what are the accounting, uh, how's the accounting of the company, like how's the balance sheet, the cash flows and stuff. Like balance sheet just means how much assets they have compared to liability, and how much liabilities do they have, how much assets do they have, how much is the the equity value for each shareholder and stuff like that. Cash flow just means like their revenue, their net profit, all of those things. You can quite easily see it here. So these are the key facts. So it is valued this much. This is the dividend yield. Dividend yield is how much they will pay you according share of the profit that they make. So for example, 0.02% means if you have one share, on that one share you'll get 0.02% of the profit that they make. So a lot of companies buy a large amount of um, a large amount of shares to get dividend payments. It's a good investment for banks. Their employees, their Jensen Huang. This guy is he's quite the hype right now. A lot of people are talking about him because he has really set the ground for AI and machine learning and all those things. Because he is investing in infrastructure of it. Now you go into the statements. So this graph, literally, this graph is what it is. If you go into the annual, like quarterly means like every 4 months. uh, every 4 months, the documents that they're giving is quarterly. Annually means like each year. That's what it means. Now this right here is what it is. You don't need to go on all these details, even though you can, but I don't think you really need it. You can just go here and just look at this and just say, okay, so total revenue was 130 billion for 2024. That's how much they made by selling their GPUs and stuff, whatever. You can also see that, by the way, what did they sell? But 130 billion they made from selling GPUs and whatever stuff they sold. From that, when they cut the costs, they get the cost of the making of the GPUs and everything, they get like 97 billion left, From that, they cut operating incomes, like, the incomes of salaries and stuff, everything like that, Then the pre-tax income comes down to 84, 84 billion. That means that they haven't given tax yet. Then after they give the tax, now it's left at 72 billion. This is their net income. That's the profit that they're making. Now, all if you distribute this profit to each shareholder, you will get the percent that the 0.02% of the profit that they made from per share from this. These are great numbers. These are one of the best numbers I have seen in a extremely long time. I've not seen these kind of financials for, I think, as long as I've been trading. This is crazy, because the revenue and the net income have a very less difference. Uh, so they're making a lot of money off of it, which is going to their pockets. So that's the thing. That's all. So now you see this, you say, oh yeah, a company is like really profitable. That's all it's giving you. This is what it is. And you see, like, every year is like growing exponentially. So it's like a great sign. You see, yeah, okay, it's amazing. It's just amazing. Then you go into the statistics. You don't really need to see anything except this chart. What this chart shows you is the, wait one sec, sorry, not this. Here, you need to go income statement, balance sheet. If you go here, you see, like, these are like total assets of the company, and these are the liabilities that they have. So they're all of their assets accumulated are worth $140 billion, and all of their liabilities accumulated are just 40 billion. So they are actually 100 billion in equity. So if you go to their statistics and their book value, let's see how much their book value is. Book value per share, their book value is like really bad. It's at 4. Oh my god, it's crazy. It is crazy. I have no idea why their book value is so bad. Hmm. I don't know. I need to look into it. It is why? Wow. Okay, that's bad. That's really bad. I think, because it's just they have a lot of shares and it's distributing quite a lot on shares. I think that probably could be the reason. Yeah. What is their EBITDA? Okay. Weird. I don't know. I think they have chunked up a lot, the company. How many shares do they have? Let's see. So the shares are like the ownership. Like if, let's say, 100% ownership, and you chunk it up into 100 pieces. Now every share is equal to 1% ownership in the company, because you distribute it into 100 shares. But if you keep distributing into like very small chunks, it gets smaller and smaller and smaller. So here you can look at the shares float. Yeah, so they have distributed their publicly available uh, ownership into 23.31 billion chunks. That's how small one share is. So if you buy like one share, it's one from this 23.31 billion shares. That's what you're buying. So you're buying this small of a percentage of the company. Yeah, that's how it gets crazy. But yeah, if you go into a balance sheet, you just need to look at the assets. Like, the assets are good, their liabilities are small, great company, great running, everything is good. Now you go into statistics, you can look at like liquidity ratios and things like that, but you don't really need to see it. All you need to see is like these charts, just this chart. Go to annual, watch annually this chart and this chart. It just needs to look good. That's all. If it looks good, that means the company is doing good. It's like it's not in a bad situation. You can go into like the estimates of analysts, like what they are thinking. So they're thinking of exponential growth in the future and stuff like that. And the revenue, it has grown exponentially, and they're obviously forecasting it to be even greater. These are all their sales. So this is what they sold, how much, and at what time, in what year. So they have all these things, that they're selling in which country. It also shows. So they have a legal obligation to share all of the data that the company has. So they have to share every single thing, like what did they sold, when did they sold, everything. So that's why we can see everything, like what's going on, who are they selling to, where they're selling to, everything. So you can make a very good estimate, uh, and you can get a very good understanding of what the company is doing and what is happening. So yeah, this is fundamental analysis in stocks. This is what it is. Believe me. You align that with the macro trends and everything, and you get just a very good understanding. Okay, what is happening. So these financials, you can go back and think like, okay, are why is this company, why are their financials so good? Why are they making so much money? Where are they getting this money from? Who are buying these GPUs from them and all these things that they're selling? And then you would come to understand, okay, yeah, AI is booming, machine learning is booming. They require a lot of data centers to support that kind of expansion. And all that expansion requires GPUs to compute, and those GPUs are being sold by NVIDIA. They are the first ones who were able to supply those GPUs and infrastructural computing technologies. So that's why they're like the root of the AI machine learning expansion, this craze that is going on nowadays. That's why they are so critical. Yeah, that's pretty much fundamental analysis. But you don't need to go any deeper than that. If you want, you can, but you don't really need to. I mean, this is what pretty much it is. You can look at everything. You can look at the book value and stuff as well to understand like the price and everything you can, but yeah, that's pretty much what it is. So, are your brains fried right now or not? Are you guys still good to go or no? Tell me.
Yes,
Yeah,
yes, good.
Okay. Yeah, yeah. Wonder.
I mean, I
Kasim.
can watch this video again, so no problem.
Yeah.
Yes,
Okay.
brother.
Yes.
When will it be the next course, inshallah? Is it
Yeah.
tomorrow
We can do it tomorrow as well. Yeah. I think we should
or what
stop
is the
here.
plan?
I should stop here now and give you guys time to absorb. And I go through this again and again, just to not this, but obviously the goal of for us is to trade. I'm just giving you these things so that you understand like what is going on and what is happening. It just gives you a perspective. That's all. Even though these things won't really, I mean, they will help,
Even
but
you
they
can show
they
us
won't
how to
really.
trade, though.
What?
Even you can like show us an example, like trading or something like that, so we can start how to do it.
Yeah, yeah, of trading. Yeah, yeah, for sure. Why
Yeah.
not? Yeah. Let's go for 10 more minutes and then we can end, inshallah. Yeah, so trading, okay. Trading, yeah, trading is when you get small, when you get into technical analysis, yeah, this was the second bit. Technical analysis in stocks is not just price action. So price action means like the up, going up and down of the price. That's what price action is. Price action is literally price doing stuff, and then you just call it price action. So if you go on the chart, this is the price, right? So if the price goes up and goes down and do all these, makes all these behaviors, we call this price action. This is how the price is moving. So that's what price action is. But for stocks, it's much more than that, because the volume is centralized. We can see all the volume that is going on, every participant that is coming in and transacting. We know like how much shares he traded at what price, when, and it is same for everyone. So this gives us a big edge, So we can actually see inside all of these prices and all of these candles, like, okay, what were the orders, like how many orders were placed at those particular prices, um, how, where were the big orders, where were, like, all these little details we can see into this into these candles. So even on TradingView, if you go to a volume footprint, wait, let it load. If you go to a footprint chart, what this shows you, okay, this is a hideous looking chart. One sec. Yeah. So if you go to like this, this footprint chart, just it on every price, it prints the volume. So for example, this was the buying volume at 197.30 to 197.40 at this particular time, between 9:30 and 9:35. So between that, at this price, these many buyers were there. You can clearly see that. And this is same for everyone. So you just you have access, everybody has access to the same data because it's centralized. So at that particular price, at that particular time, this many shares were bought and this many shares were sold. So you can see, like, at each price and each point, where are the buyers, where are the sellers, and what they are doing. So this makes a huge difference. So you can see the order flow. This is called the order flow. How uh, how the orders were placed, how the transactions are going through. Well, order flow is a bit deeper than that. Order flow is also this. This is a ladder. These are the buyers and these are the sellers. This is like an auction. So people are selling, uh, and if they come to buy from if the buyer decides to buy from this guy, a transaction happens. And when this guy decides to sell from this to this guy, then a transaction happens. So if this guy like buys from this guy, the price goes up because that was the last transacted price. But if the seller sells to this buyer below, the price will go down. So that's why when selling happens, the price actually goes down. And when the buying happens, because the buyer is buying higher, the prices go up, because that's how they transact. If this buyer does not buy from this guy and this guy does not buy from this guy, nothing will happen. The price will just be static. But they decide to buy from each other, and this buying from each other creates movement. That's what simply it is. So it is an auction. Buyers come, they say, okay, we'll buy at this particular price. We are willing to pay you this price, and the transaction happens. Once the transaction happens, it is printed. This 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 number is all the printed transactions that happened um, that happened on this side. So when these guys bought from these guys, when it happened on this side, the transaction, it is printed green. So these are all the transactions that happened on this side, that on the seller side. So buyers were buying from sellers. That's why it's a buying transaction. When the selling transaction is opposite, so it happened on this side. So sellers were selling to these buyers here. So sellers were selling, so the price was going down. These are the transactions, you're able to see them. So price action, just moving of the price, is actually based on orders and volume. How people are behaving and how people are executing their trades. This is how price moves simply. So if you go on a very small chart, you'll actually see it in more granular data. So this is how the price, fluctuates and moves around a lot. Even if you go even smaller, you'll see more fluctuations. So the price is constantly like fluctuating, but in the overall sense, it might be going down, like going zigzag down, or zigzag up, if you like really go into it. But as you zoom out, the chart starts to clear up. It starts to get less and less cluttery, because you're chunking a lot of data into one uh, candle, or like one time frame. So I'll show you candles and stuff in a second. Mm, there's the
Does
candle.
time like really affect like at what time you buy or what time you sell? Or especially like what time you buy?
The thing is, like each time, we call this a session, like each day is a session.
Yeah.
In the session, there are different times where different type of people come in. So for example, in the morning session, it's like really volatile. Usually people from 9:30 to 10:30 US time.
Mm.
The people who are trading are are people like us, and they're very volatile, they're very aggressive, they're very reactive, very emotional. So you see a lot of volume pumping in and a very reactive things happening. Investors or institutions don't really trade at this time. Then what happens that as a day goes on, retailers like are just done. They probably did what they wanted to do. They just go out. They stop trading. The institutions, if they were thinking of trading something, they go on for lunch, lunch break. So usually the session from 10:30 to, actually I can show you the volume, how it decreases. One sec. Volume. Volume. So, okay, today is a very exceptional day, but yeah. So you see, usually this is how it goes. So initially there's a lot of volume, and then as it hits like 11 or 10:30, the volume starts to decrease. It means like people go on lunch, or like they just go away. They don't really watch the charts much. So this time from 11 to, like, I would say there like 3 p.m. or like 15, it's very slow. It's very slow. You'll see very slow reaction mostly.
Yeah.
This initial time is the most volatile time. Like price would do crazy stuff in the morning, from
Mm.
9:30 to like 11. This is where most people trade, but then institution usually trade at the end, like we call this the power hour. So from 3 to 4, this is where institutions would come in, and do their stuff, whatever they want to do. So this session also sees a lot of volume. But usually the people who are sitting here are like institutions. Like the retailers usually just go away. It could be that they are, but majorly we call this is the institutional time, that's where they play. So this is how it is. So this initial period, I even made an indicator. Wait, let me.
So technically the initial one is better.
So yeah, I made this indicator, for to see different
Okay.
sessions. But yeah, so this is the initial open, and this is open volatility. That's how I labeled it. But this is where the retailers are. This is the best time to capture if you are like um, if you like to trade short bursts of volume and of price. For example, if you want to capture like really quickly $1 or $2 on Tesla, this is where you would come in, because this is where you see that kind of erratic behavior and crazy moves. If you like a slow kind of trend trader type of guy, this is where you would pretty much make your money, because you'll come in, you'll see the market stabilized a bit, and you will take the trade, thinking, getting all the data here. So you have this sentiment here, and then you base on that sentiment like a slow trade. So you take a trade here, then you sit and let it develop and stuff. Here a person might just take a trade and sell like instantly, because he's taking like quick high volatility, high stakes kind of trade. At the end, like this is where people are thinking of like holding for the next day. So they would think like, okay, today ended up like this, so I'm buying late in the afternoon for the other day. So mostly trades that are done here are for like the long term, because they are thinking of holding the stock. Either like they're swing traders who are taking trades for multiple days, or they are long-term investors who are taking like trades to hold for the longer run. Usually the ones who are doing day trade, they do day trade as soon as the day opens, because they're only doing it in the day. So that's the sentiment. Yeah, that's the time.
Yeah, because usually people what they do is like they when they buy they wait for like for $1, $2 of profit and then they sell.
Yeah, that's called scalping.
And
Scalping,
if yeah.
yeah, go.
So like when they don't get the profit, they just go for the swing trading next day or like a couple of days. And then,
Yeah, it could be, but that's the thing. If a day trade turns into a swing trade,
hmm,
that's a very bad sign. That means you're probably holding a loss, or
yeah,
it could be that you think like it has more potential and you're holding like you start to hold for a longer run, but that's not the thing. You need to make it you need to be very sure of what you're doing, and you need to make it systematic. You need to set certain condition parameters, models, goals, and specific conditions and edge where you have a specific probabilistic edge. We call it edge because you have a statistical advantage in certain situations, and you have understood that situation, and you keep whenever you see those opportunities, you take advantage of them, and you have a higher probability of winning than losing in those particular conditions. So this is an edge. And we take the data of your trading, we put it into softwares which can estimate your probability and your ratios and everything. And then we see, like, are you actually statistically profitable for a long period of time, or are you just like now experimenting. So we set like guidelines and rules and criterias and understanding and models to see, like, this is where you have edge. This is where you are statistically in advantage. This is where you win 70% of time and you lose 30% of the time. This is where you make like 200 and lose only 100. So this is the games. You'll always lose in this game, but the thing is, like, in the end, you need to have like a statistical advantage. You need to make more and lose less. That's all it is. So we do this in specific circumstance and understanding of the person. Each person is different, they think different things, but they might just come up with a condition which they understand, and they can really take benefit of that condition and or
yeah,
specific behavior. That's all it is. So swing traders have a completely different thinking, mindset, strategy. Everything is different. They're thinking differently. For a day
okay,
trader, their thinking is completely different. They're thinking completely different things. Both of them.
hmm,
So that's the case. And long-term investors are thinking completely different things. All these guys are really disconnected from each other. The day trader just thinks of the day, of what is going on in the day. He thinks of very small order flow, price action, who's buying, who's selling in that particular day in very particular time frames. He's just thinking of like 1 hour, or even like he could be thinking of 2 minutes. He needs just 2 minutes, $1. That's all he needs from the entirety of this 1 day session. That's all he needs. So everybody has their own different goals, and everybody has their mindset according to those goals. So yeah, that's how it is. Yeah. So for me, like, I divide between my accounts. So I would have one account in which I day trade, one account in which I do swing trading, another account in which I hold for long term, which I don't do. I only do swing trading and day trading. So for my day trading account, I would only do day trading in that account. I will not mix it up. For my swing trading account, I will only do it like swing trading on that, because they take two different brains. They are two different things. Yeah.
got it.
Yeah. But yeah, okay. Just to start you off, this is the candle structure. So candlestick is like just one way of representing data. That's all it is. So a candlestick represents data in a certain amount of time. So if I say a 5 minute candle, that means like all the data that is printed in those 5 minutes, and it just shows you like 4 points in those 5 minutes. So those 4 points are just the entry. So for example, let's say 9:30 just hits. The candle will start to print. The point where it started to print when the time hits, that is called the open, the start of the candle. And it will be shown by the low of the body, the low of the body in case of a green candle, and high of the body in case of a red candle. So you see this open written here. This open means like this is where, when the time came in, this is where the first print happened. This is where the first transaction happened. This is the first price which happened in those 5 minutes. So it gives you 4 data points in those time frames. So the first data is like the open, like when the time came, what was the price at that particular time. So it was this particular price. Then it gives you the close, like when those 5 minutes end, the last print that happened, where did it happen? Where was the last price when those 5 minutes ended? That is the close. In case of a green candle, it is up. In case of a red candle, it is lower. And these wicks, you see, that's why we call it a candle, because it has a body and then these wicks, these wicks just justify or tell you the highest point where the price went in those 5 minutes and the lowest point where the price went in those 5 minutes. That's all. So it gives you these 4 data points in that time frame. That's all. It's just a neat way to see the extremities of the price and the opening and the close of the price. So you can have many different types of charts. You have all these different kind of charts. You have Heiken Ashi, which is another popular one. You can have a line chart. A line chart just looks like a line, which would print just the close of each minute. So this is just giving you one data point. That's the thing. So just one data point. In terms of candle, it gives you 4 data points: the open, the close, the high, and the low. If you hold any one of these candles, you'll see the open, the high, the low, the close, and the change in that particular candle and the total volume that was in that particular candle. So it gives you this depth of data. This is what it gives you. It gives you 4 points and this data. So this is all it is. From these 4 points, you can predict certain things. You can say, okay, for example, on this particular, let's take this candle first. So the market opened up. It opened here. This was the open, which was at the price of 198.77. So it was at right here, 198.77. So it opened here, and for a moment, maybe it went higher to the point of 199.38, 39. It went up almost like, what is it, like 25 and 40, give or take, like 70 cents. So it went up 70 cents, and then it came back right down, aggressively. And then it closed close to the lowest point of the candle, which was around 197, which was at 197.70. So it just shows you that the price opened, it went higher, but it came right back down and closed near the low. So you see, this is you can say like the price opened, the buyers tried to take it up, but they failed, and the sellers were successful and they were able to take it right back down, you see. So you see some details, you see behavior happening in that particular candle. And then the next candle, what do you think of the next candle? Like, what happened? Just as I explained this, what do you think happened here?
I think so. It will grab liquidity from below, from the last one candle, like yes, and then it will push up. There is, I think so, buying orders in below the wick.
Yeah. Okay. So yeah, it opened up, it went down, and then it came right back up. So it shows that the sellers try to push it down. Once it dipped to a certain point, buyers pushed it back higher. So it just shows you a behavior of so this is a bottoming tail. We call it a tail because this candle is giving you a tail. A tail shows like sellers aggressively trying to sell it, but were not able to hold the price, and the buyers were able to win in this particular instance. So it went back up higher. So this is how you can assess each candle. It's telling you something. It's telling you from those 4 data points, it's telling you can paint a story, even though in reality it might be that for example, it could be that it opened up here and then first it went up higher, and then it went lower. That will tell you a different story, but you just want to see the close of those, like the end of those 5 minutes. Then you will see, okay, at the end, what did it accumulate it to, the price in those 5 minutes. As you can see, this is it gives you some detail, but does not give you like really in-depth detail. Like for example, Talal was saying like it grabbed liquidity. Liquidity literally means like open orders, you know. So for example, um, if I go, where is it? Yeah, here I have like written add liquidity to the market, remove liquidity to the market. If I zoom into this, so this is the depth of market, you know, this is the current price. These are all the buyers that have placed order on all these prices below, and these are all the sell orders that have been placed on prices above. Do you get it? Do you understand?
Yes, bro. Understand.
Yeah. So the thing, Rafe, Kasem, Mundir, you still there? No?
Yes.
Yeah, I'm there.
Yeah, yeah.
Yeah. Okay. So you see, this is the price. These are all the orders, like for the shares, or in this case, this is futures. So like contracts that they have put in. You can say shares. So for example, at 5,283.25 cents, you can see like 19 buy orders placed there. This this is a stack of orders, you know. This is what we call liquidity. These are called passive orders as well. Liquidity literally means like people who have orders at a certain price. Those orders are adding liquidity to the market. Why we call it liquidity? Because people can sell to them shares, or like buy shares from them. Well, okay, there's a slight difference. When you say I'm adding liquidity to the market, that means that you're participating to buy the shares. So people can sell to you, and liquidate and take their money. Taking money out of the market is called liquidation. That's why we call it liquidity. We call it liquidity because who the people sitting there are giving you their money, so you can sell them shares and take money from them. You see, and so this is what we call adding liquidity. Just literally just means like adding and placing orders, you know, at a certain price. These are not orders that are filled yet. They are just sitting there. If the sellers decide to sell at this price, you know, or sorry, yeah, sell at this price, then a transaction will happen. Then actually this guy will actually have the shares that he wanted, you know. Right now he's just sitting there, you know, he's just sitting wanting to get filled, you know. He has not been filled yet, he has not been transacted with yet, he has not been given his shares yet. If you go to the other side, these guys are removing liquidity, because what they're doing is that rather than like giving money, they're taking money away, right, from the market. That's why we say they're removing liquidity from the market. They're taking cash away rather than getting cash in the market. That's the thing. But both of them are liquidity in the general sense, in the broad sense. So when Talal was saying there's liquidity, he was saying like he was based on these laws. So what happens that many at times people place their stop orders. Stop orders mean uh, they put an order that if price goes to this point, sell my shares. I don't want it to go below this point. Let me repeat that. When, for example, let's say you bought here, right? You say, I don't want to risk more than this particular price, right? I don't want to risk more than that. My stop target is this. My profit target is this. You know, they can say that. So, for example, let's say I do this. You know, so
Just
this
like a
is
stop loss, right?
yeah, that's a stop loss. So I place my stop loss here, saying that okay, let's say this is the last low, so I'll place it below this, right? And this right here is my you know, whatever target. Now many at times below these lows, you know, you have stop orders of people. And what will market do usually, or like if with by market I means usually institutions, or because 90% of the volume in the market is controlled by the institutions, because they hold a lot of power and money, so they can really easily, you know, buy and sell shares. It's not a problem for them. So 90% of the volume in the market is actually institutions and big funds and large people. What they can do, they can literally in here, they can literally place a lot of orders or take them out. They can place a lot of orders or take them out. So what that will do, that will create an imbalance, a discrepancy in the book. We call this a book. So for example, let's say there are a lot of buyers there, and they really want to get in, but you take away a lot of orders, a sell orders, and you just leave them with, let's say, 500. There are 1,000 shares here, then, and there are only 500 shares here. So if 500 shares are here, and let's say you put 500 shares there, what will happen, that those first 500 shares will fill here, and the second 500 shares will fill here, if these guys are very aggressive, and they really want to buy it. So when they take out the supply or the sellers, they create a demand imbalance, they create a buying imbalance. If they take out the buyers from the book, they create a sell imbalance. So institutions can do that. They can do that because they would like to get in at a better price. They would not like to get in at a price which is not favorable to them. They can decide to have a price, and they can take the market there. They can manipulate the market to actually go there. They can't do that. One reason is this. Second reason can be that people actually need orders to get filled. The market actually needs order to get filled, not just institutions. So the liquidity zones, they act as magnets. Price goes to those points, fills them, and once it fills, then it goes back into the direction which it was going. That can be for many reasons, but the most major reason can be because of the institutions taken out from the book, and the second reason can be because of market makers. What market makers are, they are like the guys in between. So let me show you right now, actually. So for example, like right now the price, it fluctuates. The sellers are like sometimes let's say the sellers are at like 189.90, let's say, sorry, 188.90, and the buyers are at 182, let's say. Okay, now if the buyer decides to buy from the seller at 188.90, who is getting the difference? Like there's like a 6 cent difference in between. Who's getting the difference? A 7 cent difference. The difference is given to the guy who is actually facilitating this exchange. Those are called the market makers. What they do is like they are the ones actually buying from this particular guy and actually selling and giving to this guy. So for example, you have NASDAQ, New York Stock Exchange, you have EDGX, and a lot of different exchanges. They're just algorithms. That's what they are. What they do is that they get shares from these guys to these guys. That's all they have to do. So these guys are not actually transacting directly. They're transacting through a market maker. And a market maker gets shares from this guy to this guy. They're present on both sides. At the end of the day, what they have to do is they have to balance their book. So for example, if in the entire session, they bought 50,000 shares, they also have to sell 50,000 shares so that in the end, they have 0 shares left in their inventory, in their own capital, because they don't want to hold anything. They're just facilitating this market. They're not the ones actually holding or doing anything. They are, in the real sense, they are the traders, They are the real traders. They're actually benefiting from the margin in between the price, which is called the spread. So the market makers, they also do this. What they do is like, if their balance is like tilted too much on the supply side, they would take out their orders and fill where the buy orders are to balance their book. They usually do that. So for example, let's say that the selling the selling imbalance was a lot, right? And they had, let's say, 50,000 shares that they had sold, but they only had like 30,000 shares here. And you see like 20,000 shares are here. So what they do is that they clear the book from the buyer side for a little bit till the price goes down. Once the price goes down, they buy back these shares, and then their book is balanced. So that's what they're doing. So market makers, algorithms, institutions, they do these kind of manipulations to grab liquidity, to grab orders and shares so that they're able to do whatever they wanted to do. So that's what Talal said. He said there probably stop orders here. It's just a speculation. Even though in stock market we can actually see those orders, we can actually see those orders placed here. We can actually see like orders getting filled here, and grabbing those orders. We can actually see that. That's the beauty of stock market. In forex and other places, you have to speculate that. You just have to imagine and say, okay, there's probably someone there. In stock market, you can actually see it. Actually see liquidity being placed there. Even though you can't do that on trading view, you need other softwares, but which cost a little bit of money, but you can see that data. So that's the edge and benefit of stock market. That's why I was saying there's volume and order flow behind it, and you can really utilize it. It's different from forex or other commodities or other exchanges, which just gives you the price. Here is price, volume, and order flow. It's all of it. We do all of it together. So yeah, it came back down once the liquidity was filled, if there was any here, it went back up higher. Because the directional bias was actually up. They just wanted to balance their books, or the institution wanted a lower price to get filled at. So it went up back up higher where it was supposed to go. These are the basics. These are the little nitty-gritties of the market movements. However, price action, I think Talal already knows like what price action is.
No, not much. But I think so. There is something. Your point is good. Like there is buying much order, and second point is they will close their stop losses like above when. Yeah, these 2 points are valid from your side. I don't much knowledge about price action. I want to know what is that.
So yeah, I said 10 minutes and I'm like, I have gone like half an hour. It's crazy. Guys, what do you want to do? Do you want to know more, or should we take a break and do this tomorrow?
Yes, brother, I have to go.
Yeah.
Yes.
And
Let's
this,
meet on the weekend maybe or tomorrow.
yeah, we can continue tomorrow and go more into details, and we can practice. We can practice. Yeah, we can
Yes,
practice, and I really want to train you, not just give you lectures. So that's the thing. So inshallah, in the future days, we will just practice, and I want to build. I want to build your intuition and your sense of like, okay, what is happening and what is going on and how to capture it. So we'll go into trend lines and support and market structure and break-off structure and fair value gaps and order flows and liquidity and all of that, inshallah, later on. So there's a lot of things that I have to cover in auction market theory and a lot of things. Yeah, inshallah.
Inshallah, and you can also share your YouTube channel in the.
Yeah, well, inshallah. Yeah. Okay, brothers. Take care. Inshallah. See you tomorrow. And
yes.
tomorrow is Friday, right? Yeah, tomorrow at 6 we can do the same thing again, inshallah. Yeah.
Perfect.
Okay,
Inshallah,
guys.
brother. See you tomorrow. Assalamu alaikum.
Wa alaikum assalam wa rahmatullahi wa barakatuh.
All right. Assalamu alaikum.
Assalamu alaikum.